Interested in delaying Social Security, but retiring on your schedule? Why It Can Pay to Delay by Jennifer Lang Financial Services. If you want to retire on your schedule, not the government's, fixed index annuities may be able to help. Today, we are going to show you some examples. If you can delay taking Social Security at least until you reach full retirement age, you can avoid a payment reduction. Wait a few years more, and you can enhance your annual Social Security payout even further. How? That's where fixed index annuities come in. So how can fixed index annuities help you increase your Social Security checks? Simply replace the retirement income you would have drawn from Social Security with penalty-free withdrawals from a fixed index annuity to buy yourself as many additional years as you need. Penalty-free withdrawals are available immediately and based on your initial premium. You can take withdrawals on your schedule and know they'll remain level as long as your account value stays above that amount. Your remaining balance, when you reach your Social Security goal, can continue to grow or be converted into a supplemental income stream you can't outlive. Many retirees may be concerned about being pushed into a higher tax bracket during retirement and having to pay Medicare premium surcharges and taxes on Social Security benefits. As a result, they may seek a distribution strategy that uses up some tax-deferred assets first, before turning age 65 in order to minimize their income. Or they may choose to withdraw funds from tax-free accounts first, in order to avoid being moved into the next tax bracket. So how does the Social Security math work? Let's assume you were born in November 1958 and just turned 62. That makes you eligible for early retirement, according to the Social Security Administration. Start Social Security now, and you'll sacrifice 28.3% of every Social Security check as long as you live. Wait until full retirement age, get that much more for life. And you could earn yourself approximately 8% more each year beyond full retirement age that you wait, up to age 70. Let's take a look at the Browns and the Smiths. The Browns and the Smiths are married couples who have each determined that they will need $70,000 in annual retirement income. The Browns claim their Social Security benefits early and receive $24,000 in benefits each year. To make up the shortfall of income that they need to cover their everyday expenses, they also withdraw $46,000 from an IRA each year. The Smiths, on the other hand, delayed claiming their Social Security retirement benefits and therefore receive a higher annual benefit of $40,000. They withdraw just $30,000 from an IRA annually to fund the rest of their living expenses. The Browns' provisional income is $58,000. $46,000 in IRA withdrawals plus one-half of their Social Security benefits, or $12,000. The Smiths' provisional income is $50,000. $30,000 in IRA withdrawals plus one-half of their Social Security benefit, or $20,000. Because the Browns withdraw more IRA income than the Smiths, their provisional income is higher, which will ultimately cause a greater portion of their Social Security benefits to be taxed. The result? The Browns will pay more in taxes each year than the Smiths, and the higher tax bill could adversely impact and shrink the Browns' portfolio over time. Many investors have contributed to IRAs during their careers. Many advisors recommend that an investor roll such plans into an annuity when they near retirement. Contributing to an IRA gives pre-retirees the ability to contribute investment dollars tax-free, and for the investment to grow tax-free. For example, money contributed to an IRA is done pre-tax. The investor does not pay income tax on these funds when they are contributed. Taxes are paid when the funds are eventually withdrawn, but for most this is done during retirement years when the investor's tax bracket is lower. Also, investments in an IRA grow tax-deferred, resulting in a significantly higher retirement nest egg than an identically performing investment whose gains are taxed. Most IRAs are invested in individual stocks or in mutual funds. With that in mind, let's explore three major advantages of rolling an IRA into an annuity. First and foremost, rolling an IRA into an annuity contract provides insurance on your retirement investment. The two largest assets of most households are the house and the IRA, or other employer-sponsored plans such as a 401k. Most people wouldn't dream of not having insurance on their home. In fact, most mortgage lenders require homeowners to carry home insurance, and many states require it as well. Yet many investors approaching retirement have no insurance on their retirement plan. Rather, it can fluctuate based on the fund manager and market dynamics. Annuities can provide protection in a down market, guarantee lifetime income, and the ability to guarantee a certain amount is passed on to heirs. These can be a considerable advantages to all investors, but in particular those who have accumulated substantial assets, and then have the misfortune of retiring in a down market. Secondly, by rolling an IRA into an immediate annuity, or deferred annuity, with a lifetime income benefit, an investor can enjoy an income stream based on a predetermined and guaranteed rate, even in a down market. Recent market turbulence only serves to strengthen this point. Throughout the country, millions of workers approaching retirement have discovered that their plan balances are now too low to provide them with the income they need when they stop working. Furthermore, in addition to providing protection to one's beneficiaries, certain annuities have inflation adjustment features to ensure that lifetime income keeps up with increased cost of living. Rolling an IRA into an annuity is also a tax-free process. Annuities funded with an IRA rollover are qualified plans. This enables insurance companies to create IRA annuities into which an investor can directly deposit their retirement funds. Additionally, there are no distribution taxes either. While pension and other pre-tax distributions can be subject to taxation, when withdrawn, federal law permits prospective investors to roll their payments into an annuity tax-free. And of course, the funds within the annuity will continue to grow tax-deferred. The decision of when to take Social Security versus retirement plan benefits might change significantly if taxes are considered. A result known as the tax torpedo may occur, which refers to a high marginal tax rate that is potentially triggered when retirees take Social Security payments in the same year they receive income from IRAs and other taxable sources. The term tax torpedo alludes to the apparent unfairness of such a high tax being imposed on retirees with moderate incomes who are dependent on Social Security benefits for much of their retirement income. The Social Security taxation formula can cause a taxpayer's marginal income tax rate to exceed the top rate applicable to the highest income earners. Two conditions create the tax torpedo. Income thresholds applicable to tax on Social Security benefits have not been indexed to inflation or changed since the initial laws authorizing income tax on Social Security payments over 20 years ago were enacted. Inflation has reduced these formerly high income levels to moderate income levels, thereby exposing many middle-income retirees to a high marginal tax rate. Combining taxable IRA and retirement plan income with Social Security income in the same year triggers the torpedo, causing retirees' effective tax rates to soar. State income taxes can also amplify the tax torpedo effect. However, the effect can be reduced or avoided by taking IRA or other retirement plan distributions first and claiming Social Security retirement benefits later. This tactic gives the Social Security benefit time to mature, resulting in a higher benefit later, and ultimately reducing the amount of taxable income that a person will need to withdraw from IRAs and other taxable accounts during their retirement years. Taking smaller IRA and other plan withdrawals will result in a lower adjusted gross income, which may increase the possibility that Social Security benefits will remain tax-free. Things to remember. IRA withdrawals can create capital gains tax. IRA withdrawals can create taxable Social Security benefits. IRA tax complications for the surviving spouse. IRA tax complications for next-generation beneficiaries. Bottom line. The more you have in your 401k or IRA, the more you'll lose to taxes. And the more money you receive from your 401k or IRA, the more of your Social Security you'll lose to taxes. Next, let's look at how a fixed indexed annuity can help you take control of your tax bracket. Does the prospect of saving for retirement seem more daunting than ever? You may be concerned with market losses, the risk of outliving your money, and inflation. If you're trying to preserve your portfolio in an era of low rates and increased volatility, there's also the question of how you'll generate predictable, sustainable, and potentially increasing income. And that's only half of it. Compared to previous generations of retirees, your retirement strategy will need to rely more heavily on your personal assets to achieve your objectives. It all adds up to a lot of pressure on your portfolio. You may be thinking, sure, there are risks, but how significant are they? Consider this: too much pressure on your portfolio can lead to depleting it and running out of money sooner than you expected. So much for living comfortably in retirement. The difference between a more secure future and a more uncertain one could be the success of your retirement income strategy. Our hypothetical friends Owen and Clara are here to show us why. They're the same age. They're each starting with $750,000 in savings, and both of them want to generate $40,000 in annual income in retirement in 5 years with no more than a 4% withdrawal rate. While Owen is approaching retirement with his retirement account only, Clara plans to combine her retirement account with a fixed index annuity, or FIA. Let's start with Owen. To reach his goal, he needs to grow his $750,000 savings to $1 million in 5 years. During those 5 years, Owen will continue to grow his retirement account without making additional contributions and without making withdrawals. That will require his savings to produce an average annual return of 5.92% net fees. What are the benefits of Owen's strategy? For starters, he has control, liquidity, and flexibility of his assets, and the potential opportunity for more gains compared to other strategies. Except his assets are unprotected and exposed to risks. Like market risk, sequence of returns risk, and the possibility of outliving his money. That means his income isn't guaranteed to last his lifetime either. And as another disadvantage, his account needs to return 5.92% net fees every year. So much for taking some pressure off his retirement portfolio. Let's check in to see how Clara is doing with her combined approach. A retirement account with an FIA. In case you aren't familiar, an FIA is designed to meet long-term needs for retirement income. Some of the benefits include protection from market losses, tax deferral to help Clara grow her savings faster, the potential for credited interest based on positive changes in an external index, a death benefit to help her leave a legacy, and guaranteed income for life. Now compared to an approach that uses her retirement account only, an FIA may offer Clara less control, liquidity, and flexibility of her assets for a period of time. This is because FIAs have a surrender charge and a market value adjustment if they are surrendered too early. Also, FIAs may have less growth potential than a sole retirement account has. Certain factors like cap spreads and participation rates will limit the amount of indexed interest credited. Clara's needs may change as time goes on, which is why it's important to understand the balance between all available features with any annuity. After 5 years of waiting, her fixed index annuity would generate this much guaranteed lifetime income. As a result, she successfully reduces the pressure on her retirement account to generate the balance of income and only requires an average annual return 2.34% net fees to achieve the same $40,000 in income as Owen. Keep in mind this assumes no interest is credited to Clara's annuity during the 5-year period. In fact, any FIA interest she earns would take even more pressure off her portfolio, reducing her required average annual return of 2.34%. Clara's combined approach is more efficient than Owen's only retirement account, because it requires a lower rate of return to generate the same amount of income and reduces the overall risk of outliving her money, as well as withdrawal pressure. Her approach also adds more flexibility and potential for income and growth, because a portion of Clara's expenses are covered with guaranteed lifetime income. These factors will help take some pressure off a retirement portfolio in exchange for a level of certainty toward the lifestyle she hopes to sustain. No one, not even Owen or Clara, can predict how long they will live or how the market will affect their retirement. That's why it may be important to manage and protect a portion of your portfolio from longevity and market risk with a fixed index annuity, to help you maintain the retirement lifestyle you want for as long as you live. Ask us how a fixed index annuity could help take some pressure off of your retirement. Contact us today at jenniferlangfinancialservices.com. Thank you for the opportunity to serve you. Have a great day.